Please stay tuned for important disclosure information at the conclusion of this episode. Welcome to the Investing Insights podcast from Morningstar. In this week's podcast, Christopher Inton fills us in on everything we need to know about cryptocurrency. Alex Morozov highlights stocks set to recover after the pandemic. We share what the top money managers invested in last quarter. And Christine Benz encourages investors to make IRA and HSA contributions. Let's get started. Here are Christopher Inton from Morningstar Research Services and Jake Van Kersen from Morningstar Inc.
A few years ago, financial experts said cryptocurrency was nonsense, but flash forward and now some of them are saying you should have 1% to 2% of cryptocurrency in your portfolio. With the conversation around cryptocurrency changing so quickly, you might be wondering how it works and whether or not you should consider it.
The concept of cryptocurrency has been around for years, but the modern cryptocurrency boom began with the launch of Bitcoin in 2009. There are now thousands of cryptocurrencies in existence, but some of the most popular ones include Bitcoin, Ethereum, Litecoin, and Ripple. The basic idea is that units of cryptocurrency are created through mining, in which computers solve complicated math problems to generate coins. The original motivation for this currency was that it's not regulated and under the radar. This is why it's curious that companies like Facebook, who are notorious for tracking everything their users do, and governments, have been getting into the crypto game.
You know, I get the sense that some cryptocurrency enthusiasts might shudder at the thought of regulation, but couldn't that help it in the long run?
Well, I think the thing is, if it's going to be a currency, which is its original intended purpose, then it doesn't make sense for regulation. But since it's arguably become a store of value or investment asset, regulation could make sense because then it will allow them to purge the bad actors like terrorism, drugs, etc.
Long term, do you see cryptocurrency ever being used for day-to-day transactions?
We don't think so. And in fact, it seems that it's being referred to one as less and less. Because there's no consumer demand for cryptocurrency for anything other than investments, its price is entirely predicated on future demand.
Which is different than, say, gold, because even if everybody decided that gold wasn't a good store of investment tomorrow, then there would still be a consumer demand for jewelry and whatnot.
Right. If everyone decided tomorrow that a cryptocurrency wasn't a good store of investment, there's no real price floor to catch the fall. That makes it super volatile, and that volatility makes it even more difficult to confidently say X Bitcoin is equivalent to X dollars for transactional purposes. Yeah,
I remember the story about the guy that bought a pizza for like 10,000 Bitcoins back in 2010, because then it was as low as something like, 25 cents or something like that. Which, given that volatility, why are some now suggesting to have cryptocurrency in your portfolio?
Crypto is probably best considered as a speculative asset. Some of those experts think it works well as a diversifier because it doesn't seem to be moving with a larger economy. That being said, its short history makes it difficult to stamp that quality with significant certainty.
Given that, how could one evaluate whether or not cryptocurrency is good for their portfolio?
I guess the first question is, how much are you willing to lose? There's always the possibility that speculative assets could lose all their value. What the risk profile of the rest of your portfolio looks like is a good question too. Adding speculation to something already risky is different than a portfolio of lower risk assets. And lastly, think about your financial situation. Someone that needs asset preservation, like being near retirement, or someone young in their career, have very different financial needs.
Chris, I know you don't have a crystal ball or access to a time machine that I know of, but still, I was wondering if you could tell us if you have any expectations for the future of cryptocurrency.
It's hard because we're only a little over 10 years into cryptocurrency. We don't have the hundreds of years of historical knowledge that we do for gold. But based on the growing acceptance of cryptocurrency by financial institutions and regulators, there's signs that it might be around for a while. Additionally, it will be interesting to see if anything other than Bitcoin emerges as the top player. Because there are so many cryptocurrencies out there, it's unclear if there's any real reason why Bitcoin is the one that's really survived and thrived, beyond being the biggest and most well-known.
Chris, thanks for helping us mine the details from all the buzz about cryptocurrency out there.
Expand your investing horizons and look to the long term with Morningstar's podcast, The Long View. Join hosts Christine Benz and Jeff Patak as they talk to influential leaders in investing, advice, and personal finance. Search for and subscribe to The Long View today. Now, Alex Morozov from Morningstar Research Services shares his team's picks with Holly Black from Morningstar UK.
Welcome to Morningstar. I'm Holly Black. With me is Alex Morozov. He's Director of European Equity Research at Morningstar. Hello.
Hi, Holly. Great to be here.
So, Alex, there's plenty going on the stock market for investors to get their teeth into at the moment. What are some of the things on your mind?
Well, Holly, probably the most interesting thing is how difficult it is now to find great investment ideas in the world where the market performance would suggest that the coronavirus effects are going to be near term, and the market performance so far have left very few attractive investment opportunities in the area we would look for them, particularly among the companies with wide economic moats. The main exception here being the energy and financial sectors, but those are also the sectors where economic moats are tougher to build. There's not that many higher quality names in those spaces. So while we like in general the valuations there, I think that overall when you're looking for a combination of quality and price, we have to look a little harder.
And those sectors do have headwinds, low interest rates, low energy prices. It seems like it would be a brave investor who took a punt right now in that space.
Yeah, that is indeed correct. I think that when you look at the uncertainty rating, which is one of our staples of our methodology, a lot of the companies in the energy space in particular have higher uncertainty ratings, which was our lack of confidence around us. Now, the cash flow generation of those businesses, in part driven by the underlying price of a commodity.
So, Alex, your team keeps a list that they monitor of top stock picks. You're going to talk us through a few of those today. Where should we start?
Let's start with Airbus, a wide moat company trading at about 25% discount to intrinsic fair value estimate. This is the company that's definitely affected by the near-term compression in the air travel. So when you think of the air travel, you think of the airlines, but they also think of the airspace manufacturers. And while airlines are devastated by this near-term travel, a company like Airbus, where the order book is much longer in duration, is much better positioned. So if you think that eventually the air travel might recover to the levels that were pre-pandemic, Airbus represents a very interesting name.
Okay, and what's stock number two?
The stock number two requires very little introduction. It's the alcoholic beverage juggernaut, Anheuser-Busch InBev. This is the company that has a wide economic moat in our methodology as well. It also trades at a very attractive discount, 20% plus. And this is a company that is very well positioned in rapidly growing demographics. Think of developing markets like Latin America, think of developing markets like Africa. Anheuser-Busch is a household name there. It's a has very strong presence in those markets. And eventually, once we see some of the rebound, perhaps in the developed market occur in the consumption for alcoholic beverages, the long-term trends from the emerging markets will definitely propel this the stock.
Okay, and what is our final stock today?
The final stock is from a healthcare sector, which has been probably the best performing sector outside of technology, but nonetheless, we still have a few interesting ideas in this space. And the one that I would like to highlight today is Roche. This is a Swiss company that's a leader in the oncology business, but it also has a very strong franchise in the diagnostics. So when we think of the future of medicine, which is the companion diagnostics, the medicine that's tailored to each individual, Roche is in a really great position because it does have one of the industry's largest diagnostic franchises. And when you look at the overall portfolio of the drugs that it has, and you look at how the market is valuing it, we definitely see a disconnect.
Alex, thank you so much for your time. For Morningstar, I'm Holly Black.
6 days a week, we deliver the latest news for investors. Just say, Alexa, enable the Morningstar skill, or visit morningstar.com/Alexa. Next, here are the ultimate stock pickers' high conviction purchases.
Each quarter, we take a look at the recent transactions of some of the top money managers around today, who we call our ultimate stock pickers. Last quarter, 4 stocks were high conviction purchases for 3 of our favorite managers. What's considered a high conviction purchase? A high conviction purchase is one that makes a meaningful addition to a portfolio, as measured by the size of the purchase in relation to the size of the portfolio. First up is Apple. Morningstar assigns Apple a narrow economic moat rating and a stable moat trend. We think the firm's primary moat source is customer switching costs, because Apple bolsters the user experience with a variety of extra products, such as iPad, Apple TV, Apple Watch, and AirPods, and services, including iMessage, FaceTime, and Apple Pay, that augment Apple's sphere of influence on the consumer. We think shares are worth $98 apiece. Amazon is another high conviction purchase. Morningstar assigns Amazon a wide economic moat and a stable moat trend. It benefits from numerous competitive advantages and has emerged as the clear e-commerce leader given its size and scale, which yield an unmatched selection of low-priced goods for consumers. Amazon remains well-positioned to prosper from the secular shift toward e-commerce in the long term. We are particularly impressed by the firm's recent margin performance. We think shares are worth $4,000 each. The third high-conviction purchase is Bank of America, which Morningstar assigns a wide and stable economic moat rating. After more than a decade of work, we think Bank of America now has one of the best retail branch networks and overall retail franchises in the United States, is a Tier 1 investment bank, is a top 4 U.S. credit card issuer, is a top 3 U.S. acquirer, has a solid commercial banking franchise, and owns the Merrill Lynch franchise, which has turned into one of the leading U.S. brokerage and advisor firms. The final high conviction name among top managers is Comcast. We think Comcast has a wide economic moat and a stable moat trend. Comcast's core cable business, which accounts for more than half of the firm's value, enjoys significant competitive advantages. We think the NBC Universal acquisition has added shareholder value through a combination of a reasonable purchase price and strong execution. Comcast has steadily gained market share over its primary competitors, phone companies like AT&T and Verizon, as high-quality internet access has become a staple utility in more households. We think shares are worth $54.
And lastly, Christine Benz and Susan Jabinski from Morningstar Inc. discuss their March financial to-do list.
Hi, I'm Susan Jabinski with Morningstar. Christine Benz, who's Morningstar's Director of Personal Finance, has put together a month-by-month financial to-do list for 2021. And she's here today to talk about our March to-dos, which are making IRA and HSA contributions for 2020. Hi, Christine. Thank you for joining us today.
Hi, Susan. It's great to be here.
So you put this in sort of your March to-do list, but in reality, you really recommend that people don't wait until the last minute to make HSA and IRA contributions, right? It's not ideal to do it this late.
That's right. In fact, Vanguard had some research a few years ago. They called it the procrastination penalty. And the assertion was basically that you should make these IRA contributions as soon as you possibly can, because if you wait until the last minute, you're foregoing some compounding opportunities. And the younger you are and the more you procrastinate, the more those compounding opportunities you miss out on. So ideally, you'd be doing this earlier, as soon as you possibly can, rather than rushing in these contributions at the last minute.
So let's talk a little bit more specifically about how making a contribution to a health savings account or to an IRA can help reduce your tax bill for 2020.
Right. So you are typically able to deduct these contributions on your tax return. With health savings accounts, it's easy. If you are covered by a qualifying high deductible health care plan in 2020, you can make a contribution regardless of your income. For IRAs, there are some complicated rules about who can deduct their IRA contribution on their tax return. You have to make a traditional IRA contribution. If you're making a Roth contribution, by definition, you can't deduct it on your tax return. But if you're making a traditional IRA contribution and your income falls below certain thresholds, or you're not covered by a company retirement plan at work, you should be able to make that deductible contribution. It's also important to note, Susan, that these are what are called above the line deductions. That means that it doesn't matter whether you take the standard deduction or whether you're itemizing your deductions, you can still take advantage of these deductions, assuming that you qualify.
Now, what about people who can't deduct their contribution for 2020? Should they make the contribution anyway for 2020? Should they focus more on 2021 contribution?
Well, it really comes down to your level of investable cash. But I would say for higher income folks, you really want to think about these IRA slots as well as your company retirement plan slots, health savings account slots as really valuable resources for you. So if you're in the position to make your IRA contribution, even if you can't deduct it on your tax return, you should try to do it every year. And this is particularly important for people who aren't covered by any sort of retirement plan at work. It's also important the higher income you are, the more advantageous it is for you to take advantage of these tax sheltered savings vehicles.
Now, some IRA investors might be thinking, the stock market's actually done quite well in the past year, and they might have some trepidation with putting assets towards stocks at this point. What would you say to that?
It's a really good question, Susan. I like the idea of people determining how to invest their IRA assets by taking a step back and looking at how their portfolios are currently positioned, and then comparing that to whatever sort of benchmark they're using for setting their asset allocation. So for people getting close to retirement, or anyone who I would say is like 50 plus, chances are they are light on more defensive positioned securities, light on fixed income, for example. They may, once they've taken a look at their asset allocation, decide that they need to add to the safer part of their portfolio. For younger investors, after they've taken stock of their portfolio's asset allocation exposures, a likely area to add to would be the foreign stock space, which has underperformed US. But again, take a step back, look at where your asset allocation is today, and direct those new contributions to those areas where you might be underweight.
And what about investors who may want to contribute to an IRA, but may be a little concerned that they might actually need those assets for other things down the road?
That's another really important question. For them, I think there's a pretty easy answer, which is that they should take advantage of Roth IRA contributions. And the reason I like to recommend Roths in this context is that they give you more flexibility to take money out if you need it prior to retirement. So specifically, you can withdraw your contributions at any time and for any reason from a Roth IRA without taxes or penalties. And so that's a really nice escape hatch for people who have the best of intentions of leaving their money until retirement, but think that they might need it out sooner for some other purpose. It's really flexible from that standpoint.
And let's pivot and talk about HSA assets. How should investors be investing those assets, or thinking about investing those assets?
Here, I really like thinking about your use case for your HSA. How are you using this money on an ongoing basis? So many people use HSAs as kind of a spending vehicle to cover their healthcare costs as they incur them. If that describes your situation, then you should keep the money in something quite liquid. You really don't want to take risk with that portion of your portfolio that you might expect to spend over the next year or the next couple of years. If you're saving for retirement in an HSA, and that's the best way to take advantage of the long-term tax advantages of the HSA, well, there you might invest in something more aggressive. You might invest in alignment with the rest of your retirement portfolio. For some people, maybe it's a hybrid where they are using it for both purposes, that they're spending a little bit, but they're also saving a little bit, and putting it toward longer term vehicles. So take a step back, think about how you plan to use your HSA, and use that to decide how you invest your funds.
Well, Christine, thank you for your time today. Give us our marching orders for March. And we'll see you again next month and talk about what we should be thinking about for April.
Thanks so much, Susan.
I'm Susan Jabinsky with Morningstar. Thank you for tuning in.
That does it for this week's Investing Insights podcast from Morningstar. We hope you have enjoyed our program and we welcome your feedback. Please send your comments and questions to podcast@morningstar.com. From everyone here at Morningstar, thanks for listening. This recording is for informational purposes only and should not be considered investment advice. Opinions expressed are as of the date of recording. Such opinions are subject to change. The views and opinions of guests on this program are not necessarily those of Morningstar Inc. and its affiliates. Morningstar and its affiliates are not affiliated with this guest or his or her business affiliates unless otherwise stated. Morningstar does not guarantee the accuracy or the completeness of the data presented herein. The podcast is for informational purposes only and should not be considered tax advice. Please consult a tax and/or financial professional for advice specific to your individual circumstances. Morningstar Research Services, LLC is a subsidiary of Morningstar Inc. and is registered with and governed by the U.S. Securities and Exchange Commission. Morningstar Research Services shall not be responsible for any trading decisions, damages, or other losses resulting from or related to the information, data analysis, or opinions or their use. Past performance is not a guarantee of future results. All investments are subject to investment risk, including possible loss of principal. Individuals should seriously consider if an investment is suitable for them by referencing their own financial position, investment objectives, and risk profile before making any investment decision.